Welcome back to the deep dive. It is Friday, January 23rd, 2026. And, I have to be honest with you. If you've been glued to the charts for the last 24 hours expecting fireworks, you might be feeling a little disappointed.
Disappointed. That's putting it mildly. Bored is probably the word most people are using today.
It is quiet out there. I mean,
Yeah.
think about where we were just a few days ago.
Right.
We had that massive volatility from the Greenland tariff shock. Global markets were freaking out. And now, today,
Nothing.
the spot market for Bitcoin has basically flatlined. It's just sitting there.
It's taking a breather. But, in this industry, silence is rarely just silence. It's usually the sound of cement drying.
Cement drying, that doesn't sound particularly thrilling.
It isn't thrilling for day traders, no. But for people looking at the long term, this is actually the most exciting setup we've seen in months.
How so?
While the price of the token is sitting still, the infrastructure underneath it is absolutely exploding.
Okay, I saw the dossier for today, and it did feel like we were looking at two different worlds.
Exactly.
On one hand, traders are cautious, maybe even scared. On the other, there's this flood of news about IPOs, legal victories, and, well, tech breakthroughs.
That disconnect is the key. We are entering what I would call the infrastructure supercycle.
Okay.
And if there's one thesis, one single concept you need to wrap your head around today, it's this. The vault is currently trading at a premium to the gold.
The vault is trading at a premium to the gold. That's a catchy line, but what does that actually mean in practice? Are you saying the bank is worth more than the money inside it?
In a way, yes.
Yeah.
Or at least the market thinks the business of the bank is safer than the money inside it.
Okay.
Investors are shifting from speculating on the price of the asset to aggressively funding the custody, the security, and the legal plumbing that holds the whole economy together.
So everyone is rushing to sell the shovels because they're too nervous.
Too nervous to dig for gold.
Exactly.
And we have a perfect example of this with the IPO market.
Right. Let's start there. The custody premium. Yesterday, January 22nd, we saw the first major crypto-native IPO of 2026.
BitGo Holdings, ticker BTGO.
And for people who don't know, BitGo is a custodian. They hold crypto for big institutions.
Correct. And context is everything here. Remember, the spot market was down or flat. Sentiment was shaky because of all the geopolitical drama we discussed earlier in the week.
So by all rights, this IPO should have been a dud.
It really should have. Historically, when the asset class is tanking, the companies built on it tank too. I mean, look at Coinbase. It usually correlates pretty tightly with Bitcoin.
Right? Almost perfectly.
But look at what BitGo did. They priced the shares at $18, which was already above what they told investors they'd target.
And when the opening bell rang?
It opened at $22.43.
Wow, that's a huge pop.
It's a 24.6% premium. Right out of the gate. They raised over $212 million in cash.
In the middle of a market correction. That doesn't make sense to me. Why would investors pour money into a crypto custodian when they are afraid to buy crypto?
It's the business model. Custodial revenue is sticky.
Okay.
BitGo charges fees based on assets under management and security services. So even if the price of Bitcoin drops, institutions still need someone to hold it safely.
In fact, when things get scary, they probably want more security, not less.
That's it. It's a flight to safety. It's what you'd call a lower beta play. You're betting on the infrastructure, not the currency volatility.
Got it.
But there was one detail in the investor list for BitGo that I found absolutely fascinating. Did you catch the name YZ Labs?
I saw it, but I didn't recognize it immediately. Who are they?
YZ Labs is the venture fund backed by the former CEO of Binance, CZ.
Wait, seriously? You have a fund associated with the biggest offshore, historically unregulated exchange,
Yep.
investing in a fully regulated NYSE-listed U.S. custodian.
That is the irony, isn't it? But it's also the signal. This represents a massive cross-pollination of capital. You have this offshore crypto-native capital that has historically lived in the shadows.
Right.
And where is it trying to go?
It's trying to get into the New York Stock Exchange. It wants to be legitimate.
It's seeking onshore U.S. regulated safety. It suggests a future where even the offshore giants know that the end game is U.S. regulation. BitGo is becoming the bridge for that money.
That is wild. So the vault thesis holds up on the institutional side. But what about for regular people? The dossier mentions Ledger is making moves too.
Right. So following right on the heels of the BitGo news, the Financial Times is reporting that Ledger, the French hardware wallet maker, is eyeing a U.S. IPO.
And Ledger is the little USB stick you keep in your safe,
Yeah.
right? Self-custody.
Essentially, yes. And the rumors are they are targeting a valuation over $4 billion.
$4 billion. That's up 167% from their valuation in 2023.
It's massive growth.
But again, why? Is this the same flight to safety logic?
It is, but from a different angle. We call this the fear trade.
The fear trade, that sounds ominous.
Well, think about the last few years for a retail investor. You've seen hacks, you've seen exchanges collapse, you've seen social engineering thefts, like that $282 million theft we saw just recently.
Well, it feels like every week someone loses their life savings.
Exactly. And every single time that happens, Ledger's revenue spikes. People get scared, they pull their money off the exchanges, and they buy a hardware wallet.
So BitGo makes money when institutions want trust.
And Ledger makes money when individuals lose trust in everyone else.
Okay, that makes total sense. But here's what confuses me about Ledger. They're a French company. Europe has MiCA, which everyone tells me is this fantastic, clear regulatory framework. So why come to the U.S. to list? Why not just stay in Paris?
The great question. And the CEO, Pascal Gauthier, gave a very, very blunt answer. He said, money is in New York.
Wow, simple as that.
It's the liquidity premium. You can have the best regulations in the world, you can have all the clarity in Europe, but if the deep pockets, the pension funds, and the massive capital allocators are in Manhattan, that is where you list your company.
It really confirms that despite all the headaches, the U.S. is still the gravitational center of the financial universe.
For now, yes. The vault is in New York, even if the gold is global.
Okay, so we have established that safety sells, but I want to shift gears to a story that honestly, I didn't know how to interpret it at first. The Farcaster news.
This is one of the most significant stories of the year, I think.
So I saw the headline, Merkle Manufactory returns capital. And my immediate thought was, oh, they failed.
Right.
Because usually when a startup gives money back, it means they're shutting the doors. But the dossier calls it an honorable exit.
It is an honorable exit, and it is incredibly rare. So Merkle Manufactory is the company behind Farcaster, the decentralized social network.
Right. They raised a ton of money from heavy hitters like Paradigm and A16s.
And they are giving back $180 million.
$180 million.
Now, just pause and think about the alternative. In the crypto VC world, what usually happens when a project isn't working out?
They pivot.
Yeah.
Or they just keep going until the money runs out.
Usually they do what we call a soft rug. They know the product isn't going to be the next Facebook, but they have $100 million in the bank. So they just drift.
Right.
They pay themselves fat salaries, they build zombie protocols that nobody uses, and they burn the cash for 5 or 6 years until it hits zero.
It's a slow death, but they get paid the whole time.
Exactly. It's technically legal, but it's ethically bankrupt. Merkle did the opposite. They looked at their metrics and said, you know what? We aren't going to generate the venture scale returns we promised.
So instead of burning it,
Instead of burning that $180 million on a pipe dream, they're wiring it back to the investors.
that is actually pretty noble. But does this mean Farcaster is dead? Because I know people who use it.
No, and that's the nuance. The protocol lives on. It's decentralized code. But the corporate entity that was trying to monetize it is winding down. They actually sold the assets, the client app, the control of the protocol, to a company called Nanar, which is an infrastructure provider.
So the app keeps working, but the business strategy changes.
Precisely. And the reason for the failure is fascinating. The dossier calls it a strategic pivot from social first to wallet first.
Explain that to me. Because I thought Farcaster was all about social media.
That was the bet. Dan Romero, the founder, spent 4 years trying to build a decentralized Twitter. But what they found was that the users who stuck around weren't there just to post cat photos or argue politics.
They were there for something else.
They were there to transact. Tipping, minting NFTs, paying for things. The wallet inside the app was the feature that people actually loved. The social feed was just a complicated interface for the wallet.
That is a huge insight. We've been talking about SocialFi for years.
And this might be the proof that social isn't a standalone product in Web3. Social is just a feature of your bank account. You don't sign up for a decentralized Facebook. You sign up for a wallet that lets you communicate with people you are paying.
It's amazing to see a founder just admit that, though. We built a social network, but you guys just wanted a wallet.
It takes a lot of ego death to admit that and return the money, but it signals a maturing industry. We are moving from growth at all costs to actual capital discipline.
It's refreshing. But speaking of discipline, or maybe a different kind of strategy, let's talk about what's happening at the state level. The dossier uses a term I haven't seen before, State maxing.
This is a trend that has been bubbling under the surface, but now it has erupted in Kansas, of all places.
Kansas. Senate Bill 34. I read the summary and my jaw hit the floor. The state pension system, KPES, is looking to put up to 10% of its funds into Bitcoin ETFs.
10%.
That sounds incredibly high. I mean, these are teachers and firefighters' retirements. Usually pension funds are super conservative, right?
Extremely. Usually they cap alternative assets at maybe 1% or 2%. A 10% allocation ceiling is it's unheard of. It signals a profound conviction.
Is it conviction or is it reckless?
That's the debate. But look at it from their perspective. They have billions in unfunded liabilities money they owe to retirees that they don't have yet.
Okay.
They're looking at the federal dollar, looking at inflation, and they see their purchasing power just melting away.
So they're trying to hedge against the dollar itself.
Exactly. They are saying we need an asset that can outperform the monetary debasement of the U.S. dollar. And they are using the ETFs to do it because it's a regulated product. They aren't holding private keys on a sticky note in the governor's mansion.
That's a relief. But state maxing implies this isn't just about Kansas.
No. The theory is that states will start competing to be Bitcoin sanctuaries. If Kansas shores up its balance sheet with Bitcoin, and Bitcoin, say, goes to $1 million, Kansas suddenly has the best funded pension system in the country.
And other states will have to follow suit or get left behind.
It's FOMO at the sovereign level. It's game theory.
And while Kansas is playing game theory with pensions, Binance is playing musical chairs with European regulators.
They've made a move to Greece.
The Greek gambit. This is another fascinating piece of the infrastructure puzzle.
So Binance established a new entity called Binary Greece. Why?
They're applying for a license under MiCA, the European crypto law. And the reason they chose Greece comes down to a mechanism called passporting.
Passporting, like a travel passport.
Similar concept. The European Union is a single market. If you get a banking or crypto license in one member state like Greece, you can legally passport that license to operate in all 27 member states.
So you don't need a license in Germany and France and Spain separately.
Exactly. You just need one door to open, and you're in the whole house.
So why Greece? Why not just get the license in France or Germany where they have, bigger markets?
Well, Binance has had, let's call them friction points, with French regulators, and Germany's regulators are notoriously strict and slow.
Yeah. Greece represents a clean slate. They haven't issued many MiCA licenses yet, so there's no backlog.
They are looking for the fastest line at the DMV.
Basically. And they are racing against the clock. The deadline for compliance is July 1st, 2026. If they don't have a license by then, they get shut out of the European market entirely.
So it's an existential threat.
It is. It's smart. Regulatory arbitrage. You go where the friction is lowest because it's about survival.
Speaking of friction and survival, we have to talk about the lawsuit. President Trump filing a $5 billion lawsuit against JP Morgan and Jamie Dimon.
Now, we need to be careful here. This is a political firestorm.
Of course.
The lawsuit alleges debanking based on political bias.
Right, and we aren't here to take sides on the politics of it, but when I read this, I immediately thought about the crypto companies.
Exactly. If you strip away the names Trump and Dimon and just look at the mechanism being debated, this is critical for our industry. This is about Operation Choke Point 2.0.
And for listeners who don't know, that's the idea that banks were pressured to cut off crypto companies, right?
Mm-hmm.
Not because they broke the law, but just because the banks didn't like them.
Correct. Arbitrary account closures, reputational risk. The industry has been fighting this for years. So if a major court case establishes that banks cannot arbitrarily close accounts without specific non-political commercial reasons, that changes everything.
It basically criminalizes the main weapon used against crypto businesses.
It would be a massive tailwind. It would mean that as long as you are legal, you are entitled to banking access. So, ironically, a personal battle between a president and a CEO could end up solving one of the biggest headaches for crypto startups.
It's a strange world we live in. Okay, we've talked money, laws, and politics. Let's finish with some pure, high-octane technology.
Yes.
The dossier mentions a stress test by a project called MegaETH.
This is where we get to geek out a little bit. This is about the L2 wars.
Layer 2s. These are the networks built on top of Ethereum to make it faster.
Right. And for a long time, the trade-off is simple. If you wanted security, you used Ethereum. If you wanted speed, like real speed, you had to leave Ethereum and use something like Solana.
Because Ethereum was slow and expensive.
Exactly. But MegaETH just ran a mainnet stress test that completely challenges that narrative.
Hmm.
They sustained over 16,000 transactions per second.
Whoa. Wait a minute. 16,000.
Sustained peaks of 47,000.
Put that in perspective for me. What does regular Ethereum do?
Layer 1 Ethereum, depending on the day, maybe 15 to 30 transactions per second.
So we are talking about 1,000 times faster.
Yes. And the latency, the time it takes for a transaction to be confirmed, was 10 milliseconds.
10 milliseconds. That is literally the blink of an eye.
It's faster than a blink. It's real time. It's web server speed. And here is why it matters. This is happening on the EVM, the Ethereum Virtual Machine. It proves that you don't need to abandon the Ethereum standard to get high-frequency performance.
So what does that actually unlock? Is it just for bragging rights?
No, it unlocks entirely new categories of apps. Think about high-frequency trading. You can't do that on a 12-second block time. You can do it on 10 milliseconds.
Or complex gaming where every move is on-chain?
Exactly. So if the EVM can do this, does Solana lose its edge?
It certainly shrinks the moat.
It commoditizes speed. If everyone is fast, then you have to compete on liquidity and developer tools. And Ethereum has always had the developer tools.
It feels like the tech is finally catching up to the promises we heard 5 years ago.
It is. The plumbing is finally ready for the flood.
Which brings us back to where we started. The market is quiet, the price is flat, but the builders are absolutely frantic.
The panic from earlier in the week has faded. The ETF outflows have stabilized. But don't mistake calm for safety in the short term. The smart money is still very cautious.
You mentioned a whale in the notes. Air Force Commander.
Yeah, that's the wallet label. This entity got liquidated for $20 million during the crash a few days ago.
Ouch.
But instead of walking away, they just re-entered. They opened a new $150 million short position.
So they are betting $150 million that the price is going to crash again.
They are betting this recovery is a dead cat bounce. So while the infrastructure is booming, the trading floor is still a battlefield.
So putting it all together for the listener, how should they be thinking about this weird moment in time?
I think you have to separate the signal from the noise. The noise is the daily price action.
Right.
The signal is the building. Capital is flowing into custody, like BitGo, into legal structures, like the Kansas pensions, and into high-performance tech, like MegaETH.
The vault is more valuable than the gold right now.
For now, yes.
I want to leave everyone with a final thought, going back to that Farcaster story.
Go for it.
We're seeing a founder return $180 million instead of burning it.
It's a powerful image.
For the last decade, the status symbol in tech was how much money you raised. I raised a Series B was the badge of honor.
Even if you had no revenue.
Exactly. But what if Farcaster just changed the game? What if the new status symbol is returning capital when the thesis doesn't work?
It's an interesting thought. If reverse exits become a sign of integrity and competence, a sign that, hey, I can be trusted with your money next time, we could see a wave of this.
It would make the entire venture ecosystem healthier. A world where founders are celebrated for saving investors' money rather than wasting it.
It would certainly clear out the zombies.
We will be watching to see if that trend holds. That is it for today's deep dive into the infrastructure supercycle. We will be back tomorrow to see if that whale gets liquidated again or if the vault keeps getting stronger. Thanks for listening.
Stay curious.